Hello and welcome to TheoTrade. My name is Doc Severson and this is the Theo Night Report for Tuesday, August 30th. All right, we are smack dab in the middle of one of the lamest weeks of the year volume-wise. I mean, it really doesn't get any worse than this, with the exception of the time between Christmas and New Year's and perhaps Thanksgiving week as well, too. So this is viewed as a holiday week because we're getting a 3-day weekend coming up here, and what we're going to see as of late Friday morning is we're going to see a bunch of empty swivel chairs as traders basically shut down their workstations and walk away. So I think that first hour, though, of the cash open on Friday is going to be very, very busy. This is why we've got a little report coming up here on Friday. Okay, it's called the employment situation. And we're expecting 175,000 jobs to be added. They couldn't make this any easier to jump over because the last few have been in excess of 200,000 or so. So the last one was 255,000. So setting the bar at 175 is pretty low, and it would be a big, big surprise, a big shock if that didn't occur. Now, if we do get a number that's perhaps over 200,000, then I think that's going to set off a chain of dominoes. The next thing I think that we're going to see is that we're going to see this countdown to FOMC rates of the CME group. We're going to see the probability for the rate hike on September 21st. So this is the next major Fed meeting, next only Fed meeting, and it is a major one. This is where they also do, as well as the policy release, they also do the press conference with the chairwoman, Janet Yellen. And so right now it's setting at 27% probability of a rate hike then. So regardless of the fact that they completely jawboned the market up last week, talking about, oh yeah, it's almost a given that we're going to be raising rates at least once this year, which puts this one firmly into play. But you'd look at this at 27% and say, you know, there's a 73% chance that they do nothing with that. So as of Friday morning, this is going to be the key indicator I think everybody will watch. So again, if there is a big number, if there's a big jobs number, then this will climb probably past 50%, probably past 50%, right? So if the jobs report is below 175, if it's as bad as the one back in June with like 38,000, then we're going to see this number shrink, and I don't know what the market's going to do. Now, there's every indication that if we do have a good jobs number, it's going to be similar to the last reaction that we had at the beginning of August, where we had a pretty positive reaction. So in July and August, we had pretty good jobs reports. We had pretty positive reactions from the market. And it's less about the market looking forward than it is just more certainty coming back into play. It's more of a certainty play to buy at that point or buy in relief. So perhaps some orders are being withheld simply based on the risk, as well as shorts covering that causes that. Now, in the next couple of minutes, let me walk you through what I'm expecting the market to do. So this is not any kind of crystal ball, anything like that. It's just purely based on what I'm seeing in the chart, number one, and then number two, answering the question, what would have to occur to put the maximum amount of pain on the greatest number of traders? This is the way that markets move. Markets move because they have to, because people are in pain. Either in pain from sitting on the sidelines and watching a rally like what we had in 2013. The pain of sitting on the sidelines and watching a rally like this occur, especially if you're a long-only fund and it's your job and you're compensated based on how well your fund stacks up against the S&P, the pain of watching this one goes is actually greater than taking a loss on the trade. So it's a known fact of this. So we had almost a couple of years of this going straight up. So that's one form of pain, and I think the pain that most people are familiar with occurs very rapidly to the downside as they're positioned way too long, and everybody on that side of the boat, the wind shifts and all of a sudden they get thrown overboard as the boom swings around. So markets move because they have to. First of all, from fund managers holding their nose and just jumping on board saying, I've got to get on. I can't afford to miss this rally. That's one form of pain. And then I can't afford to stay in this position. I've got to sell out while I still have some gains left. So those forms of pain will occur if we start to move. And so looking at this chart, you have to ask yourself, where is the pain here? Where is the pain? Now, based on the Brexit rally, all these gains were rather easy because people shorted the devil out of this market way down there. And so much of this that got the price up and over resistance that was in place for the last 2 years occurred on much of the short covering. People being positioned incorrectly and making too much out of the whole Brexit vote when all of a sudden everybody said, wait a minute, this is not going to happen for a long time, and what's the big deal anyway? All of a sudden, way too many people on the wrong side of the boat had too large a position and had to turn around and buy those positions back, and that helped to drive the price up. But now, who's buying at the highs? With the S&P at 2,200, and who knows if anybody actually watches PE ratios anymore. I'm sure they've got to be astronomical, especially with the earnings that have been turning out for the last 6 quarters, our earnings recession. So who is buying at the highs? Nobody's buying at the highs. We're just keeping things propped up. So you have to ask yourself, where's the pain with this market? Where is the pain with this market? Well, I think I have an answer to that. What I think I would have to see that would generate the maximum amount of pain, and this kind of goes along with what we typically see with rallies, is that when we see some rally like this coming off the bottom, we will typically see a very flat spot near the middle, and then we will see a charge for the skies here at the very end. This is what I call a parabolic tail. This is when everybody chases after the market. Can you imagine a good jobs report that generated a positive reaction and got the S&P somewhere up near 2,200? Can you imagine all those fund managers that frankly have not been doing very well to this point of the year? And with time running out, we're just about to get into the fourth quarter. All of a sudden, they have no choice but to chase this move. They have no choice but to chase this move higher. Or there could be a number of people positioned short looking at this massive target down here at 2,100. We all know that when markets do something like this, when they consolidate, they break out, they always come back down to revisit that. So there could be a tremendous amount of longs just waiting for the price to revisit 2,100 from above. And so they may have to buy because they're wrong. They may have to chase this market higher. But there's only going to be so many of them because I think they're going to get faded. I think what will happen is any move that goes berserk to the upside from Friday's jobs report will get faded into, and I believe it's going to come crashing right back down here to 2,100. This is all very, very normal if you take into context what's happening at the larger time frames. If we look at the larger time frames, a look at this chart on the weekly chart, this would be a very, very normal thing. You would look at this if you saw this chart just come down here and give him, if we had a trend line that was right around here, give a brief kiss of this and then rebound right off of that. You would say, yep, seen it 100 times before, right? Now this is going to feel like we are absolutely crashing. If we see a move that comes from about 2,200 and drops 100 points, remember you have to keep in mind the context of what we're doing. 100 points is not that much in the market anymore. It's only about 5%. Where just a few years ago, a 100-point move used to be 10% of the value of the S&P 500. Now it's no big deal. So for the S&P to drop 100 points is going to be no big deal. That's going to be, in my mind, the big opportunity that we may see in the next few weeks is not only this initial push higher, but then subsequently selling into that move, taking the opposite side of the herd and seeing that move come back down here. Now, this may not come to fruition at all. We may get a move straight down from here. So the initial move may be straight to the downside from a really, really bad jobs report on Friday. But again, I think we'll get a big bounce from there because all of a sudden everybody will say, wait a minute, if it's a bad jobs report, then the Fed's out of play for another 3 months, maybe until next year, and we'll get a bounce from there. So again, all this reverse psychology, markets move because they have to. Markets move because people make emotional decisions when volatility comes. And all you've got to do is basically box yourself in. You got to pre-program yourself to say, if it jumps out here, I'm not going to chase this. I'm going to wait until we can fade this back down again. And if it goes to the downside, I'm not going to short this. I'm going to look for a place to go long from support. So use the rest of this week to kind of program yourself for how you're going to handle the volatility that we'll undoubtedly start to see creep in by the end of this week. I believe this low volatility funk is going to be over with very, very soon. So that's it for today's report. Thanks for listening, folks. See you tomorrow.